Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Investing Podcast. This is Phil Wong. With me, as always, is Brad Price, and joining us again is Kim Nguyen. Hey Kim.
Hey guys.
So last time we discussed, the upcoming rule changes with the qualifying rate going up and everything. So now we're a few weeks into June. How have you found the qualifying rate has affected home sales at all at this point?
Honestly, I feel like the intention, as you guys know, with the new qualifying rate changes is just to kind of cool down the market. But if anything, it hasn't really done much, to be honest with you. Like I'm still seeing a lot of clients buy a home. I'm still seeing a lot of competing offers to be honest, which is it still baffles my mind, especially in Calgary. But overall, in general, I don't think it's really slowed anything down. I think if anything, it's pushed some people out of the market, but not many.
Have you noticed maybe the higher house prices have those been affected at all? Anything above $500,000?
Not so much, still going strong. So if
Okay.
anything, I'm seeing a little bit more luxury sale homes, actually being bought because they think that this is kind of the bottom now. Like it's reached the bottom, it's only going to go up. So I've actually seen an uptick in that, which is again, it's great news. That means green shoots. I'm hoping anyways that it's green shoots, especially in Alberta now compared to last year. Oh, like huge changes.
If it's still crazy out there, Kim, how long is the turnaround time right now for most banks to go through that application process,
Mhm.
confirm everything, provide a commitment, and then be in a position to fund?
The thing is, the turnaround time right now, and this is across all lenders, okay? Every lender is slammed because number one, um, with the increase of activity in the resale market, new builds, like people just buying a home, that's increased, and a lot of the lenders they didn't feel that this would happen. So even before COVID, believe it or not, there were a lot of lenders that actually let some underwriting staff go because they didn't think that the demand would be here. So what has ended up happening is you let people go, like critical staff go, and then now we have this crazy housing market, and you don't have enough staff to handle it. And on top of that, with lower rates as well, we're seeing an influx of clients who have existing mortgages who want to break it and do a refinance. So you've got business from coming from all different angles, and you let go like a good chunk of your staff before the during the pandemic. So now like trying to bring them back up, like you got to go through the training process, and some of the critical staff, like they've gone on to other other industries. If you do have a purchase though, with most banks right now, we're looking at anywhere between 1 to 2 weeks, 1 to 1.5 weeks just for a review.
Whether it's a renewal or you're looking to, you're coming up to the end of a mortgage that you may have. What is the typical time frame that people can start the process? Is it 120 days across the board? Is it different for each lender? Like, what does that look like, Kim?
It's always 120 days, right? So when you are 120 days out from your renewal, that's when you can start shopping. That's when you can start the refinance process. And one of the reasons why, Brad, that they said, hey, come back in 30 days, the main simple reason is because they know that if they submit your deal now, you're just creating excess backlog. They just don't have the capacity to deal with your deal. Like as unfortunate as that sounds, they're trying to prevent that, right? They're trying to kind of get everything that's already in the queue just pushed through. If these trends continue where we've got such a hot housing market and low interest rates where everyone just, everyone under the sun and moon wants to break their term or just transfer their mortgage at renewal, this is what happens, right? There's just too much business going in and just not enough bodies to handle it. My recommendation for any client is if you do have a renewal, start it at the 120-day mark. Like start it, right? Don't waste any time. Most clients aren't aware of this, but it's really important to read your contract, especially when you're coming up for renewal, because there's certain banks where by the renewal date, so let's say your renewal date is August 1st, if you haven't done anything with that bank, what they will do is sometimes they re-renew you back into the same term, or if not, they'll renew you into a closed term where even if you were to transfer the mortgage one day late, like let's say August 2nd, you got to pay a penalty. During the time period of when you're looking to commercialize your portfolio, you want all of your properties to line up accordingly, right? So when you make that transfer, you're not paying an arm and a leg for a penalty. But keep in mind though, depending on the lender, there's certain lenders that don't allow you to renew into an open term. You're getting close to that financing wall and you want to look into the commercial realm. Just make sure like the mortgages that you currently have already allow you to renew into an open term. Because lenders are so busy right now, some of them won't even review your deal unless you have the full package up front, right? If you're even missing a pay stub, they'll send the deal back and be like, well, no, you're still missing this. You didn't pass the triage stage. And in that case, now you're going back to the bottom of the queue again. So it's very important to have everything up front. That way it creates a smoother experience. We can get your stuff over to the lender quicker. Being organized will really, really help you out. And by being organized, the easiest thing to do is when you see it, take a picture of it on your phone. Like we're all attached to our smartphones. Download like an app like Tiny Scanner or Cam Scanner where it automatically converts the picture to like a PDF, and then just upload it to one of your OneDrive, Google Drive, whatever you use. That way you have it. And when you're working with your mortgage professional, they're going to ask for those documents. It's easy to be like, here's the link, here's all my documents. And it's one of those things where it just helps all parties, because if you can be a little bit more organized with your paperwork, it will help your mortgage professional as well. Chances are high that there is a backup offer. And if you need to ask for anything like an extension to your financing condition or extension to closing or whatever the case is, you may lose the deal that way. Insured mortgage rates, we all know that it's much lower than conventional rates. So if you are looking to get the best interest rates in the market, hands down, if you're buying a home with less than 20%, you'll get it. And sometimes the difference, depending on the lender, it can be really big. Some of them could be, as low as 10 basis points, but some of them could be as high as 30 basis points. Sometimes you're better off just doing the 20% and not paying a premium. But yes, your interest rate is slightly higher, but you got to do the math, right? You got to really break it down to see if it makes sense. So that's one part there. The second part is, it is true. Like lots of lenders right now, they love insured mortgage, because insured mortgage business is a healthy book in their opinion. They have nothing to lose. If something were to happen where a client can't pay their loan or anything, the banks, basically say, well, this isn't my problem. It's insured. A generic rate would be 1.84%, 5 years fixed. Whereas if you were to take like an actual conventional rate, so meaning you're buying a home with 20% more, 20% down payment or more, and you're using a 30-year amortization, that rate will then jump up to 2.34%. If you don't have a lot of equity built into, your first and second home that is already insured, the chances of them insuring another home it'll be very slim because the risk is too high. One of the common things that we see from the insurers, they'll say, okay, well, Phil, you've got like 5 homes already. Like you want your sixth home to be like an insured mortgage. Like that's kind of risky for us, right? And the key thing that you have to remember is they'll take a look at a few things such as your equity position in the existing homes. If you're really at the cusp and like, maybe your property values have gone down and you don't really have a lot of equity, that's an easy basis for them to decline you and be like, no, you're too risky for us, right? If any of your rentals were vacant and you had to sell it, like you don't have much left, right? So that could be a ground for them to decline you. This program, like to do a down payment less than 20%, it really is there to promote home ownership first and foremost. So my recommendations for my clients right now is, I always say, try to give yourself at least 10 business days for condition of finance, right? Especially if you're looking to get like the best market rates, like, dealing with the best lender out there to kind of give you that flexibility. 10 business days. Okay. So call it 2 weeks. For closing dates, be careful with this one. Quick closes are not permitted now. Okay. There's some lenders that will do it, but when I say quick closing, this is closings earlier than 30 days. So if let's say you see a home today and you want to put an offer in and close on it in 2 weeks, forget about it. You're not going to get the best lending options, period, end of story. So just make sure that your closing date is at least 30 days out, so a month out, just to give, again, the lenders ample time to work on the deal, an appraiser ample time should they need to appraise the home, and your lawyer, right? If you see a lawyer, hug them, right? This is a crazy month for them. They need a hug. Thanks, guys.